Imagine a world where artificial intelligence does not just recommend products or drive cars. It manages wealth, predicts markets, and transforms the very way money moves around the world. That is the future Jensen Huang is talking about. And when Huang speaks, the tech and finance worlds listen. He is not just the CEO of NVIDIA, a company that revolutionized graphics and computing. He's a visionary at the crossroads of AI and money. Huang's perspective is not about tomorrow or next year. He's thinking in decades. He sees artificial intelligence as a force that will redefine the rules of economics, investment, and personal finance. And the implications are staggering. For decades, financial markets have relied on humans to analyze data, make predictions, and execute trades. Even with algorithms, human judgment was at the center. But Huang argues that AI will shift this entirely. Machines will process trillions of data points in real time, detect patterns invisible to humans, and act with precision that was previously unimaginable. Risk assessment, portfolio optimization, fraud detection, credit evaluation. All of these functions will evolve faster than most people anticipate. Consider trading first. Traditional trading strategies rely on historical data and often lag market movements. AI, particularly the kind powered by advanced GPUs and neural networks that Huang's company develops, can analyze real-time news, social sentiment, macroeconomic indicators, and even climate data to anticipate market swings. Imagine an AI that sees subtle shifts in global supply chains and predicts commodity price moves before human traders even notice. That is no longer science fiction. It is already happening in limited forms. And Huang believes we're just scratching the surface. But Huang is not just focused on Wall Street. He sees AI democratizing financial access. Personal wealth management, once the domain of the elite, could become far more intelligent and accessible. Algorithms could create highly customized investment strategies for individuals, adjusting portfolios dynamically based on changing economic conditions or even personal circumstances. Imagine an AI that notices your spending, your risk appetite, and your future income, and optimizes your investments continuously. That level of personalization could transform retirement planning, student loan management, and everyday financial decisions. Then there's the matter of trust. Financial AI is not only about efficiency, it is about transparency and reliability. Huang has emphasized that for AI to truly manage money, systems must be explainable. Clients and regulators need to understand why an algorithm made a decision. This is one of the major challenges today. Neural networks can be black boxes, extremely powerful but opaque. Huang envisions new architectures and AI governance frameworks that combine both sophistication and interpretability, ensuring that automated financial decisions are trustworthy. Another critical aspect Huang highlights is the intersection of AI and risk management. In traditional finance, risk is quantified based on historical volatility, correlations, and stress tests. AI can simulate countless scenarios simultaneously, even unprecedented ones. It can model the impact of sudden geopolitical events, cyber attacks, or extreme weather events on financial systems. This could create a resilience in markets that human analysts alone can never match. Financial institutions that harness AI effectively may navigate shocks far more efficiently, potentially preventing crises before they escalate. Of course, Huang does not ignore the risks. Any transformative technology carries profound implications. There are regulatory challenges, ethical concerns, and the potential for systemic risk if AI-driven decisions dominate markets without sufficient oversight. Huang has cautioned that society must balance innovation with caution. AI can amplify human error or bias just as easily as it can improve efficiency. Financial institutions, policymakers, and technologists will need to collaborate to build frameworks that allow AI to thrive safely. There's also a labor dimension. AI could displace certain financial roles while creating new ones. Analysts, traders, and even some middle management positions may be automated, but new expertise in AI modeling, oversight, cybersecurity, and ethical governance will become critical. Huang frames this not as a threat, but as a reallocation of talent. A chance to elevate human work into higher value, strategic roles, while leaving repetitive or computationally heavy tasks to machines. Perhaps the most profound implication Huang discusses is the democratization of predictive intelligence. In the past, access to sophisticated market insights was limited to top-tier institutions. AI could change that. Individuals and smaller companies could access tools that were previously only available to major banks or hedge funds. This could reshape wealth inequality, financial inclusion, and even economic mobility, allowing people in previously underserved regions to participate more fully in global markets. Huang also envisions AI enabling a new era of decentralized finance. Blockchain, smart contracts, and AI-driven asset management could converge to create systems where trust is embedded in code, and financial intermediaries become less dominant. Risk assessment, auditing, and compliance could be automated and transparent, opening the door to new forms of lending, investing, and insurance that are faster, cheaper, and more adaptive. But there's one more subtle, yet critical idea Huang emphasizes. AI in finance is not about replacing humans. It is about augmenting them. Humans bring judgment, creativity, and ethical reasoning. AI brings computational power, speed, and pattern recognition. The synergy could redefine what it means to manage money. A fund manager in the future might be less of a trader and more of a strategist, guiding AI tools to execute in alignment with human insight and societal goals. For businesses, this means competitive dynamics will shift dramatically. Companies that leverage AI in financial strategy, supply chain finance, and investment planning will have a substantial advantage. Those that fail to adapt may struggle to compete in a world where speed, accuracy, and predictive intelligence dictate outcomes. Huang frequently underscores that the next decade is not just about innovation in AI, but about adopting it intelligently. The winners will be those who combine technology, governance, and vision. Now here's an interesting thought. Huang has suggested that AI might even reshape monetary policy itself. Central banks could use predictive AI models to forecast inflation, unemployment, and liquidity dynamics with greater precision. Policies could be implemented dynamically, adapting to emerging economic conditions in near real time. That does not remove human decision-making, but it could dramatically enhance effectiveness and reduce policy lags that have historically contributed to cycles of boom and bust. Imagine the implications for everyday life. Your mortgage rate, your investment portfolio, your savings plan, and even how governments manage social benefits could be dynamically optimized by AI systems. Financial shocks might be mitigated before they affect the real economy. Credit could be allocated more efficiently. Risk exposure could be minimized. Yet, Huang is careful to stress that this future requires preparation. Infrastructure must be robust. Regulations must evolve. Ethical frameworks must be established. And perhaps most importantly, trust must be earned. People need to understand and feel confident that AI is not a black box dictating their financial lives, but a tool amplifying human intelligence responsibly. If you step back, what Huang is describing is nothing short of a paradigm shift. The way we think about money, wealth, risk, and value is changing. The financial world is moving from a human-centric model to an intelligence-augmented model, where AI is not optional. It is a core component of strategy and stability, and this is happening faster than most people realize. GPUs, neural networks, and AI frameworks are advancing at an exponential pace. Data availability is exploding, global connectivity is increasing, and regulatory frameworks, while slower to adapt, are beginning to recognize the need to integrate AI responsibly into financial systems. So here's the point that often gets overlooked. This is not just about technology. It is about a fundamental rethinking of money itself. What it means to earn, invest, save, and transfer value will be profoundly reshaped. Wealth management, banking, trading, and public finance may never be the same. Huang's warning, or perhaps more accurately, his vision, is clear. The future of AI money is already here in its early stages. Those who ignore it may find themselves unprepared for a world where financial intelligence is defined not just by human judgment, but by how effectively you leverage AI to anticipate, analyze, and act. The question is not whether AI will influence money. It is how deeply and whether we are ready to harness its power responsibly. Because the next era of finance will not be measured solely in dollars or cents. It will be measured in data, algorithms, and the ability to act on insights faster than anyone else. And Jensen Huang is challenging us to see that future before it arrives. Because in finance, those who see it early often gain the greatest advantage. If you think about it, the world is about to enter a phase where money itself becomes a platform for intelligence, not just a medium of exchange. And that is the revolution Huang is betting on. AI not simply supporting finance, but redefining what finance can be.